if you look at the ratio between stock market value and liquidity, the ratio is now trading towards the bottom end of its range. Normally, what you'd expect is a ratio of about 0.55. We were down at one stage in March below 0.3, which is almost near historic lows. We've now rebounded to about 0.45. So you can see there's still potential scope for markets to continue going. The worry is that we're inflating a bubble, and bubbles burst, as we know, but we still may have several months of gains before that happens. But what we would urge investors to do is to start to diversify. On the one asset that is bound to go up a lot more is gold. And gold goes up when two things happen. Number one, the Federal Reserve eases aggressively. And number two, the People's Bank of China starts to ease. And that's what we're seeing. The concurrence of these two big central banks pumping in money is magic news for the gold price.
I'll come back to that if we have time later on. But you're just showing off now on page 5 of your liquidity framework notes, if you don't mind me saying, Michael. I mean, I wasn't too bad at maths at school, but what on earth is this? It's just your clients will be looking at this one and going, really? I understand the words underneath it, but why don't you just tell us what this crazy equation means?
Well, all it's saying very simply is that you don't necessarily have to use price earnings multiples to value equity markets. You can do it in a different way. And you can say, well, OK, number one is the flow of liquidity. And that's one factor. And the second factor is how that liquidity is allocated within portfolios. So if I give you lots of cash, suddenly a windfall gain, the question is, how are you going to allocate your investment portfolio? And if you normally have 50% of your investments in equities and the other half in other assets, and you suddenly find that the other assets, i.e. cash, are now up to 80% of your portfolio, you're going to rebalance and you're going to put money into equities. And that simply is what's happening worldwide. The amount of money that has been forced into investor portfolios globally is eye-watering. And this is the point. Money moves markets. If people have money, they spend it. And ultimately, what you're seeing in this particular flow is money is going first into financial markets, where it always goes, and then it's going to start to drift out or trickle out into the real economies. So what you've got to expect is probably a better economic news than many economists have been expecting. And I would say, lo and behold, that's exactly what we're getting. Look at the rebound in some of the US data, in looking at things like the ISM surveys that recently came out for June. You saw V-shaped patterns in both manufacturing and non-manufacturing, and that was really the spur to markets at the beginning of this week.